general, the market's obviously been very pleased. The stock market's been very pleased with what it's seen since the election, as the market's been up nicely. Interestingly, the bond market has had the opposite impact, where we've actually seen bonds sell off and interest rates rise. And so I think as we look at 2017, we think, regardless of one's politics, it's clear that there's likely to be fiscal stimulus, there's likely to be tax reform, and there's likely to be a more pro-business tone out of Washington. So for corporate growth, revenue growth and earnings, that's a positive. And all else being equal, that would be a positive for equity investors. The flip side, or the thing that we need to watch out for, though, is interest rates. So since the election, interest rates have moved up pretty sharply in a short period of time. They're still at very low levels by historical standards, and at levels that we would continue to see as very supportive of business and of investing. The fourth quarter, you've seen performance coming from very different areas, and the biggest one there would be financials. So what we've seen is that since the election, and now there's a belief that interest rates have started to move up and a belief that they'll continue to move higher, financial companies that are interest rate sensitive, that benefit from rising rates, have done very well. So a great example would be a company like MetLife, which is a sizable holding for us. MetLife was a meaningful detractor coming into the fourth quarter. It was probably one of our 2 or 3 worst performing stocks of the year, and then it's performed very nicely since the election, and indeed is now up nicely on the year, as people realize that the impact of rising rates on a life insurance company are profoundly positive. Since the election, actually, the utilities have underperformed pretty materially. And yet in our portfolios, at least in this very short period since the election, we've held up relatively well. We've never been just about current yield. We've always been about dividend growth. I think there's a perception that if rates start to rise, dividend-paying stocks may not be the place you want to be. But we actually believe that's not true, that the dividend growth will be a meaningful offset for investors. And indeed, if we look back at historical examples, we've seen that in past cycles of rising interest rates, this has played out exactly as we've just talked about, where dividend growers have maybe sold off in the short term, but over the fullness of the business cycle have actually caught up and indeed outperformed. We've had a pretty good year, and so we have a fair number of names that have been relative underperformers. So names that haven't kept up as well as the market, but in a market that's up, close, as we sit here right around the holiday time, market's up north of 10%. We don't have a lot of stocks that are actually down meaningfully on the year, just relative underperformers. I think there's a couple of factors that bear watching. I think the first would be valuations. So 7 or 8 years into this market cycle, we're at fuller valuations than you would be early in a cycle. That always presents some risks. We talked about interest rates, which would be a potential area of risk should those move meaningfully higher. We would also point out that we believe, just more uncertainty broadly right now than at most other times in the past, both on sort of a geopolitical, not just the U.S. basis, but all around the world, whether it's the Syrian crisis, things in Europe, Russia, China. There's more uncertainty broadly, and then with the new administration, there seems to be more uncertainty about what direction they'll really take than we've generally had in the past with things like this. And the last one would be that while people have become very enthused about the economic prospects, and we hope they're right, the economy on a global basis continues to be really very slow. As much as people might be excited about the prospects of what's going to happen under new administration, it's hard to see the growth rate in the United States or around the world moving meaningfully higher, given some of the larger long-term things like demographics and productivity.